Is Iran closer than ever to a regime collapse amid protests fueled by popular anger over the government's handling of a downed passenger jet? Some argue that this is the most vulnerable the Islamic Republic's regime has been since its founding in 1979. Joining me to talk about this today is Professor Steve Hanke. He's a professor of applied economics over at Johns Hopkins University. Good to have you back on, Professor. Happy New Year.
Yeah, same to you, Daniela. Great to be with you.
Well, I wanted to get your thoughts on, what's happening over in Iran right now. Protests, people unhappy, a lot of instability we're seeing right now. What are your thoughts and take on it?
Well, if you look at the press and the videos and so forth coming out of Tehran, you have a scene of kind of chaos. That's the picture, and a lot of volatility and instability and unhappiness and so forth. However, I like to look at the black market for the Iranian rial, a currency, and it's been incredibly stable for the last month. And it's actually appreciated the last few days. Now, the black market is a free market, so that is an indicator that there's calm in the foreign exchange market. There might be chaos in the streets, right, or some of the streets. So we're getting kind of a mixed picture. So I'm a little bit skeptical of the news reports coming out. I like to look at market prices to see what's going on.
What, if any, are the longer lasting impacts of the U.S. involvement in Iran on global trade?
Well, it's bad because the sanctions weapon, the financial sanctions weapon, which the U.S. loves to use pretty much indiscriminately now around the world, the cutting edge of those sanctions happens to be Iran. So that's just their preferred weapon. And if they're using it in Iran and ramping them up every time the Iranians do something they don't approve of, it has kind of a ripple effect because those sanctions then are used in other places, Venezuela, you name it, North Korea. We know all these places, but there are also feedback effects like Europe. The Nord Stream 2, the big gas pipeline coming in from Russia, the U.S. is imposing sanctions on companies that are involved in the construction of Nord Stream 2. Of course, the Europeans are totally angry about this, which they should be. Now, that's an interference in international trade. So the U.S. has pretty much gone rogue with this, I would say. So it hurts international trade. It's unambiguous.
Okay. Professor, on to the U.S. economy now. The Fed has been aggressive in monetary easing in the last 4 years. Have they created a risk of serious inflation here?
Well, they have been aggressive. Actually, it's been rather recent. It's been in the last year that things have really changed dramatically. A year ago, the best measure for the money supply in the United States is put out by the Center for Financial Stability in New York. It's called Divizia M4. It's a very broad measure of money, very accurate and precise. Professor Bill Barnett is the one in charge of this, and it's just the greatest measure you can have, Divizia M4. A year ago, the year-over-year increase in Divizia M4 was 3.5% per year. Today, the year-over-year rate of change is 7.4%. So it's dramatically increased. The thing is, over double what it was in terms of rate of change. In the last 3 months, the annualized rate of change in that Divizia M4 has been going up about 11%. So it's accelerating. It's way above trend. And eventually, you have to look at these things in terms of the money supply goes up and money dominates. Forget all these other things in the press. It's a lot of noise. The thing you have to look at is the money supply growth. Money supply is growing way above trend. Asset prices are going up. Economic activity is going up. And eventually, inflation will go up. And when inflation starts going up, interest rates will actually go up. Interest rates follow inflation, not the other way around.
So that
A lot of what we're getting now, this nonsense about, Mr. Carney said that we're in a liquidity trap last week. He did an interview with the FT, and everyone's singing the same song. Carney is just clear. He says it's a liquidity trap, a Keynesian liquidity trap. What is that? That means the interest rate has gone down so low that they can't get it any lower, and they can't effectively increase the money supply. And that means that everybody repeats the Fed and the central banks are out of ammunition. It's just completely ridiculous. They are not out of ammunition. The liquidity trap idea is completely irrelevant. They're increasing the money supply, and eventually, at the end of the line, that will increase inflation. So, and when that happens, interest rates will start going up.
So the chance of a recession for you, I know there was so much talk of it in the run-up to the year end. Is it extremely low for you now that we'd see a recession?
Danielle, the chance of a recession in the United States is extremely, extremely low, with money growing like it is. And if you look at the international scene, the U.S. consensus growth figure is 1.8%. I think it will be at least 2.5% growth in the United States. Europe, the consensus is 1%. I think Europe will be 1.3%. Japan, 0.6% consensus. I think it'll be 1%. And on down the line until you get to everyone is going to be growing at, I think, a greater than consensus rate of growth for the next year, except China. China will be right on their consensus of 5.8, and India will be much less than the consensus. The consensus is 6.7. I think there'll be trouble getting at 5% in India. What's this mean for commodity markets? It means the commodity markets have, I think, bottomed out and are turning around, and we'll see some upticks in commodity prices this year.
And I want to dig a little deeper on the commodity price front. But before, I just want to ask you this. If the picture is just growth for the U.S., do you think that it's a shoo-in for President Trump to re-win this election this year?
Well, let's put it this way. The economy and the stock market is both will be in good shape, should be in good shape. And this will make a challenge against Trump very difficult, because again, there's a lot of noise, and of course, if you look at the challengers, there's not much to write home about. I mean, they're pretty pathetic. So Trump is Trump, but the point is the economy is the economy, and pocketbooks are pocketbooks, and those factors still play an enormous part in elections in the United States. So anything could happen. You know, there's a tremendous amount of uncertainty, but just looking at the bare facts, I would say that the economy might not make Trump a shoo-in, but it'll put him in pretty good shape and pretty tough to challenge.
You mentioned the commodities. I wanted to get your thoughts on gold, which last week hit a 7-year high. We've been having traction that we haven't seen in a very long time across all the precious metals front, even on platinum, palladium, rhodium, hitting $7,000. So tell us more about what you make of the run-up here on the metals front, Professor. Is it just, investors seeking safe haven here?
Well, the goal, remember the last time we spoke, I said that, in fact, the last couple of years when we've spoken, I thought gold would be in a trading range of 1,200 to 1,400.
Yes.
And it's clearly broken out of that, and it's in a bull market. It's going up. You want to be exposed to gold in 2020.
I mean, even Wall Street's embracing gold. I'm hearing talk of 1,800, 1,900 from people who never wanted to touch gold before. So when you hear these numbers, do they sound astronomical to you? Does it sound realistic to you in terms of forecasts?
Well, I don't really have a point estimate. When something's in a bull market, I just want to be in. and take the ride.
Fair enough.
But the numbers you gave me don't sound fantastic. No, I mean they don't sound like they're some gold bug going off on the sky is going to fall tomorrow kind of thing, and gold's going to the moon.
Professor Hanke, thank you so much for your thoughts. I appreciate you joining us today.
Thank you very much. Good to see you.
Good to see you as well. And thank you for watching. We will have much more for you, so be sure to stay tuned to Kitco News. And joining me now on the sidelines of the Vancouver Resource Investment Conference, we're kicking things off.
Well, we were all bullish on the panel. I think everybody saw the macro pictures being very constructive for gold.
The key kernels of any of the 21st century civilization is energy and minerals.
So the problem is we're just not finding enough new deposits to replace what's being mined. That's where the problem is, and that's where the opportunity is.
You can come to a mining conference like this and say all nice things to these companies, and then meanwhile you short their stocks when you see they're full of
I think all of the problems that I've diagnosed in the U.S. economy have just gotten worse.
I always tell my friends that love gold, focus on the copper. You get all the gold as a byproduct.
Gold can actually really start getting bullish. I don't think a bull market has really begun.